Welcome to this explainer. Today, we're going to peel back the layers of something you literally use every single day, stress over, and work incredibly hard for, but might not truly understand. We're talking about money. So let's kick things off with a question that kind of shatters our everyday assumptions. Just think about your own bank account for a second, or a physical bill in your wallet right now. What actually gives that piece of paper or that digital number on your screen its power? Why can you trade it for food, shelter, or a brand new car? Well, this perfectly illustrates our current reality. Almost all the money we use today is what's called fiat money. Fiat money is unbacked currency with absolutely zero intrinsic use value. You can't eat it, you can't build a house out of it. Its value is derived entirely from social convention and the simple fact that a government has officially declared it legal tender. The crazy thing here is that money is essentially an emergent market phenomenon built entirely on a shared belief. That cash in your pocket? It's basically a highly sophisticated collective illusion that we all just agree to trust. If we all woke up tomorrow and stopped believing in the US dollar or the euro, it would instantly become worthless paper. Section 1. What makes money, money? The core functions and properties. For any item to actually act as money, it's got to have 6 specific properties. It has to be fungible, meaning $1 is completely identical to another. It must be durable to withstand repeated use, divisible into smaller change, portable so you can easily carry it, widely acceptable, and most importantly, scarce. Without scarcity, the whole illusion of value collapses. But beyond just its physical traits, money has specific jobs to do. There's this classic 1919 couplet by William Stanley Jevons that elegantly summarizes how economists view those jobs. Money's a matter of functions for a medium, a measure, a standard, a store. It acts as a medium of exchange, so we don't have to barter, a unit of account to measure value, a standard of deferred payment for settling debts, and a store of value so you can actually save for the future. Now, this creates a really fascinating inherent tension. Think about it. On one hand, being a medium of exchange requires money to circulate freely to avoid the massive inefficiencies of a barter system. But on the other hand, acting as a store of value requires you to hold and save that money reliably so it doesn't lose purchasing power. Basically, storing value requires you to hold onto it, but being a medium of exchange requires you to spend it. Section 2. A brief history of money. From shells to fiat. To see how humanity solved this tension, we can trace a journey across thousands of years of human ingenuity. We start way back, like 100,000 years ago, with early gift economies and barter. Jump to 640 BC, and the Lydians meant the first stamped gold and silver coins. By the 11th century, the Chinese Song dynasty introduces the very first paper money, called jiaozi. Europe eventually catches up in 1661 when Stockholm's Banco issues their first paper banknotes. And then we hit a massive turning point in 1971 when the US officially suspended the convertibility of the dollar to gold, detaching global currency from physical commodities entirely. Along this journey, humanity tried out some pretty wild concepts. We used representative money, which was paper directly backed by fixed commodities like gold. But we also experimented with something called demurrage currency. This was money designed to intentionally lose value over time. The whole point was to force people to spend it quickly, which stimulated the circular flow of income during really tough economic times, like the Great Depression. Section 3. Creating money from thin air. The mechanics of the money supply. All of that historical context brings us to the most mind-bending part of this whole system. If you break down the liquidity in our financial system, it's fundamentally divided. You have narrow money, or M0, which is the physical cash and central bank deposits created by central banks. But then you have M1, M2, and M3, known as broad money. These are your everyday checking, savings, and institutional deposits. And when you look at who actually creates that broad money, it's commercial banks, which reveals a massive public misconception. The primary source of new broad money is actually not the central bank printer at all. The vast majority of money circulating in our economy is created by everyday commercial banks. So, how exactly does that happen? Well, when you go in to take out a loan, the bank doesn't just walk down to a vault and hand you someone else's savings. Instead, through the magic of fractional reserve banking, they record your loan as a new deposit. They literally keystroke brand new electronic bank money into existence on a digital ledger. Seriously, every single time a bank issues a loan, new money is born out of thin air. Section 4. Who controls the supply? monetary policy, and central banks. That is a frankly staggering amount of power. Since commercial banks are creating money from nothing, central banks, like the Federal Reserve in the US, the ECB, or the Bank of England, have to oversee it. They don't control this daily money creation directly, but they influence it heavily using four really powerful monetary policy tools. They adjust interest rates, they conduct open market operations by buying and selling assets, they provide forward guidance to the markets, and they change the reserve requirements that dictate exactly how much cash banks must actually keep on hand. It's a total high-wire act for them. If they misstep and the money supply grows way too fast, you get hyperinflation, which rapidly destroys your purchasing power and economic stability. But on the flip side, if the money supply grows too slowly, you get crushing deflation. That makes money more valuable, sure, but it causes prices, wages, and overall economic output to absolutely plummet. Section 5. The future of money, digital and decentralized. As we've seen, money is really just a technology for tracking value. And like all technologies, it's evolving rapidly. A recent history shows a massive shift from physical coins and paper to purely digital ledgers. By 1990, all U.S. transfers between central and commercial banks were completely electronic. By the 2000s, the vast majority of all global money existed solely as digital database entries. And then, a major disruption hit in 2008 with the introduction of Bitcoin. This established a decentralized, borderless digital currency, allowing a network of computers to enforce rules and reach consensus, without needing permission from any government or central bank. And that leads us to the big unknown. I want to leave you with this final thought. As we look back at the history and the mechanics of this brilliant collective illusion we call money, will the next evolution of our shared social convention rely on traditional centralized control, or will it be built entirely on decentralized, borderless networks? What do you think will ultimately back the value of our currencies in the future? Thanks for diving into this explainer with me, and keep questioning the illusion of value.